So one of the biggest things that we see when it comes to any kind of bad decision in investing, it's really about those behavioral finance errors. And the biggest thing we see is people using your emotion. Now, when it comes to emotion, we're humans. Emotion's okay. Emotion's not a bad thing, but when it comes to investing, it's probably the biggest thing you want to take out of the equation when making a decision.
Absolutely. I mean, we see this time and time again. It kind of goes into the sense of how you would bet on sports.
Yep.
If you grew up in Cleveland, you may be a huge Browns fan. And we all love our Browns, but we know that they don't have the highest probability of winning, right?
I'm a Steelers fan, so I've been used to winning. I know last time we talked about how I love to win, and I think that might be why, because I've been so used to winning my entire life watching the Steelers.
Well, there's always next year or next couple of years. Who knows when they'll get to play again. But going to Vegas, I don't think I would sit there and be like, okay, I'm choosing the Browns to win it all. And what do you think the spread on that would look like?
Oh, you get paid a ton if they did actually win. That's for sure. You probably get paid, 1,000 to 1? Something like that. $1,000 into $1 million real quick.
Absolutely. But that is what you want to make sure you're not doing when it's coming to real investing, right? You cannot let your emotions get into it. There may be somewhere that you love to eat. They just have the best cheeseburgers, and every time you go there, you just have the best time. That doesn't mean that they're the best company to invest in, right? Because they may not have a good management team. They may not have a good growth story. And they may not have a catalyst that they're going to break through and get themselves to the next level.
Right. And there's so many variables. And that's why having that strong balance sheet or companies that do have a future, when we go through our portfolio x-ray, which is one of the things we offer on our website, it's a free tool. You enter in your stock holdings and we evaluate them based on their management team, their valuation, and their growth. And if a company's does not have a growth story at all, what's really the point in owning it? I mean, I understand that stock's going to have good balance sheets and have to be profitable. But if there's no really future outlook of what the company's going to do, it's really hard to own that, especially if you're a longer-term investor. If you're younger and you're holding these stocks in your IRAs and you're looking for a lot of growth over the long term, you have to look for that metric. I mean, geez, my watch. Did you hear that?
Oh,
Hope you guys heard that. But the biggest thing is, when we take a look at growth, we take a look at all these different sectors that you kind of hear all the time, tech or these virtual reality or, semiconductors like NVIDIA, communications, Google, Amazon, all these big. Geez, my words today.
You just can't talk today.
All these big tech stocks is typically what you hear when it comes to these growth stories because that is the future, right?
So not only do you need the growth story, right? So that's just one component. We talked about a good management team. So, Tesla has been killing it lately. I mean, they've gone up extraordinarily, right? But if you look at the management team, if you look at Elon Musk, who is willing to go on TV and smoke marijuana, that scared a lot of investors. And that's why one component of how you're looking at underlying stock can't dictate the whole situation, right? Because they had a great growth story.
Yeah.
They came up with all of these ideas like the new, big rig trucks that are going to be out there that are going to be fully electric.
Yep.
That is a huge, huge catalyst that has just catapulted them to the next level.
Right.
So now we have, good growth story, we have good management, but I believe we also have to have those buy and sell strategies, right?
Yeah.
So a lot of people just, they happen to have the money that day, so they go to a stock they like and they deploy it. They don't look at the charts. They don't pick a price that they want to wait for to jump into this thing. They just jump into it all willy-nilly, right?
Well, one of the biggest things is we call it anchoring when they decide, okay, I'm going to sell it here no matter what. And that's not a bad thing. At least you have the discipline, but you always have to be changing with the changing information, with the changing environment. That's why looking at the technicals, you mentioned charts, looking at the technicals is so important because you can kind of see where supply and demand is going to affect the stock price. So if you saw in the past that you bought a stock and then it had trouble getting above $85 3 times, that could be a triple top, we call it. So it's going to have trouble getting back above that stock price in the future. So that might be a good place you want to sell it at because it probably won't get back above that. So I'm just using simple supply and demand metrics. You can really predict stock price movement. It's not going to be accurate every single time, but it's how you can tilt the odds in your favor.
Yep. And then if you go the other direction, we have our fundamental analysis, right? So that is looking at that underlying stock and figuring out what the intrinsic value is. So there's a lot of mathematical equations that, if you're interested, just reach out to us. We'd be happy to send you those over. But you can figure out what that stock price should be at, right? So we know if we get close to that, then we have a sell strategy. And you mentioned having that sell strategy on the way down. One of my personal sell strategies for myself is if something drops 20% after I buy it, I don't care. I normally sell it.
Yeah.
You have to have that stop loss at some point, even though, it may have come back, and I may have shot myself in the foot there, but I'm not going to let that thing go down 50%, 70% and lose everything.
And even diversifying just a little bit, whether it be through 3 or 4 different stocks rather than just putting all your money into one, that in itself allows you to be more accurate in regards to the growth on your portfolio. Because if you pick one stock, you're exposed to so much business risk, right? Because if that business fails or something goes wrong down the road, let's say another coronavirus situation hits and you weren't prepared for that and it might affect the business a lot. Well, if you diversify a little bit outside of that, at least you'll be exposed to maybe different sectors or at least a little bit different business risk. And we're not saying you have to diversify 50, 60 different stocks. That's also called over diversifying. That's possible as well. Because if you just own everything, then what's the point in investing really? Because you're just going to track the whole market. You're trying to deliver some alpha. Right? You're trying to outperform the markets a little bit, especially at a younger age. So the thing is, it's okay to just pick a couple different stocks and not go either all into 50, 60 stocks or into one stock.
Right. When it comes to diversification, it's not about just being in stocks, right? It's about what different asset classes are out there and what do they bring to the table. So there's stocks, which we call equities, right? There's bonds, which we like to call fixed income. There's annuities out there. Those are going to act differently than equities or bonds, but again, in a similar way. Then there's commodities. Gold. Gold tends to go the opposite direction of the market. Tends to, not always, but when we have these big pullbacks, when people are nervous about equities, you tend to see this flight to gold, right? So those are going to move in different directions. And then you have alternative strategies. So, when it gets into options and things like that, then it gets really complicated. It gets to a point where you probably want to at least research it intensely or get some professional help. Right. Because if you get on the wrong side of an options trade and you're leveraged, that's when you really feel those big hits.
Right. And what we're talking about again today is behavioral finance and why it's important to be logical rather than emotional. Rationality, how we can base decisions on actual factual, time-tested strategies is going to be very beneficial because, like I said, the key is, and a lot of people don't get this, people think there's an all-in-one strategy that's going to work all the time, and there's no such thing when investing. If you are right 75% of the time, you're going to be very, very successful, typically. But it's really important as well to, like Joe said, cut the losses when they happen because if you don't, that one loser could completely wipe out all those gains. So if you win 75% of the time and you might make 10, 15, 20% on those winners, that one loser you have that you never cut the loss could be wiped out 60, 70, 80% if you do not cut those losses, which will completely counteract the 3 winners that you had.
Yeah, I mean, I've been there. Luke and I like to go to the casino. We enjoy playing blackjack together.
I've been more into craps lately. I've really been. I go to Vegas in 2.5 weeks, and I can't wait because my mom has not played craps before. And it's a lot of fun when you get on one of those rolls. You just keep rolling, and you keep racking in money for the whole table. So it's gonna be a lot of fun. I'm excited to show my mother.
You get the whole table going,
yeah,
right?
You get the whole table going. That's a little different though because I think there's only 3 or 4 people on a table, so it's not gonna be the same. But still, if you get on an 8, 9, 10, 11, 12 roll, definitely will be a lot of fun.
Right. So bringing back that blackjack table, right? Yep. So I have a golden rule. And I've broken my golden rule.
He has. I've seen him break his golden rule.
And he begged me not to break my golden rule.
I was like, Joe, come back here right now.
Yep. And that is never go back to the ATM, right? You go with that X amount of money. You got to realize you're there for fun. You're most likely going to lose. And once that X amount of money is gone, you're done.
Yeah.
But when you get that emotion, when you get that, I have to beat the dealer. If you ever think in your brain that you're going to beat the dealer, I promise you most of the time you're going to go home without money.
Well, let's talk about a video I actually posted on Twitter a couple of days ago about betting against the house. I think that should be the name of a book. I should write a book on that, betting against the house, and talk about the stock market and gambling. That'd be awesome.
So what points do you want to hit with that?
So what points do I want to hit with that? I want to hit that the stock market is the house. Okay, stocks are supposed to go up. Our last video was about stonks only go up, right? So that in itself is what stocks inherently are supposed to do. Companies are supposed to grow over time, right? I mean, that's what they're meant for. That's why they go public. They're trying to please shareholders. They're investing in research and development areas. They're investing in their employees who are supposed to return good productivity to the company. So
and that's why the small caps should outperform, right? Because if you have a good small cap
and you have a lot of growth,
you're taking inherent risk, right? So, there is a chance that small cap company doesn't make it. You do lose your investment. But those small cap companies become mid cap companies. Those mid cap companies become large cap companies. And that's why over time, if you have, some allocation to the small caps over a long period of time, 20, 30 years, it should outperform those large cap companies.
Exactly. But when it comes down to it, stocks are supposed to go up. So when we talk about the blackjack table, right? The longer you're there at blackjack, I think blackjack's very, very close to 50-50 if you play how you're supposed to play by the book. I think you still have, the house still has about 1 or 2% on you.
I think 1%.
That 1 or 2% that the house has, though, the longer you're there at the table, the more at risk you are at losing money. So if you get ahead very, very quickly and you're lucky, you maybe made 100% of your money within like 20 minutes, you should leave. That's what we talk about, sell discipline. You should leave. But my point is you should really never bet against the house. If you never had a gamble in your life, that's probably the best decision because you are probably going to lose more money gambling, unless you play poker. Poker's more strategy, but we won't get into that. You'll lose more money gambling the longer you're there, the more you do it. So when it comes to stocks, if you want to bet with the house, just buy the market, right? All these people are trying to short the market, trying to get all fancy.
Yep.
Me personally, myself, I have my personal account. I got some puts, which the puts aren't looking very good, right?
Yeah, so what is a put is when you short the market, which means you're betting against it. So Luke, taking his advice over here, bet against the house.
I bet against the house because fundamentally we are overvalued. There's no fundamental analyst out there that's going to say we're where we should be, right? But the market can always trade at a very high premium, especially when the Fed continues to back everything, and there's all these different variables keep propping up the market right now. So the market can continually be irrational for a very, very long time. But my point is if you want to generate a ton of wealth over time, and believe me, the puts that I bought, those were more of a hedge against, everything else that I own. So that way that, if the market did drop, I'd be protected on all the other assets that I am long. But in regards to portfolio positioning over the long term, if you want a lot of growth, you have to be invested in the market. I mean, you're not going to be making, if you're shorting the market over the long term, you're obviously going to lose a ton of money because historically the market returns 6 or 7% every single year.
Yeah. And then when it goes down for a shorter period of time than when it goes up.
Yep.
So those bull markets, those up periods are normally going to be a lot longer than the time that we have these bear market and these recessionary type environments that we're in. So, I mean, if you're using it as a hedge, that's one thing. So what he's saying is basically, if he has this little bit invested in an option or a short option so that he's betting that it goes down, when his long positions go down, this goes up, kind of keeps him even. So you're hedging your risk. But when you go heavily in one direction, especially with the options, you're betting at that point.
Right. It is. It's more gambling than anything. That's what you don't want to do. You want to make sure that investing is not gambling, especially if you don't know what you're doing. When I mean don't know what you're doing, I mean that you're not a professional trader, right? If you have a full-time job outside of investing or outside of financial planning, advising, things like that, there's no way, people can't work 2 or 3 jobs. It's just not possible because we as humans only have enough time in the day
we got to
sleep. To mentally be there to perform the best at 1 or 2 single things, right? So if you have a job outside of this, it's really hard to try to keep yourself educated, keep up with all the ever-changing information because every single day when we're here, we're looking at articles, we're looking at the Bloomberg terminals, we're here looking at all this different software that's going to impact our decisions on a daily basis.
Right. And, coming back to if you're young, We keep saying you need to be in the stock market, you need to be in equities. Why? Because there's no other place to make money. And that's part of the reason that this market continues to go up with everything that 2020 just slapped us in the face with. So all these reasons being, people have this FOMO that they want to get in, and people have nowhere else to make money. If you go into a savings account, you're lucky to make 1%. Yeah. I think the highest out there is 1.25%.
Yeah.
So if you go into bonds, if you go into these other fixed income areas, you are probably not even keeping up with inflation.
No.
Therefore, over time, your spending power, the amount of money, the ability that you can buy with that dollar is going down.
In summer, you're losing money.
Right. So there's nowhere else to go. There's nowhere else to go in this environment. I mean, back in the early 80s, interest rates were, for a CD, you can make 12%.
Yeah.
That right now it's insane. It's crazy to think about.
What do you call that, though, when you have nowhere else to go and it just gets bigger and bigger and bigger?
So you're seeing a bubble.
Exactly. It's a very big bubble. I mean, I'm not saying we are at the peak of the bubble yet. The bubble could keep going and going. That's why it's called a bubble, right? It takes very long for the bubble to burst. But when it does burst, it gets very painful. That's why we saw that 30% cut real quick, because people were scared. We were at a little bit of a bubble considering our valuations for the growth, and it burst a little bit. And now we're fully recovered. We could go to all-time highs, go to 3,500, 4,000 on the S&P maybe in the next coming years.
It's just crazy to think about.
The bubble could be here right now, and it could get bigger and then bigger and then bigger. It might not burst till it's out here. But when it bursts, it's going to hurt.
But think about where we are. If you took today and you took a year ago, it's 2019, and you remember what it felt like when things were great and our economy just could not even get a dent in it.
Yeah.
We're just full steam ahead. Do you feel like we're in a better spot right now?
No.
Or where we were in 2019?
Well, what I will say for that is, fundamentally, do I think we're in a better spot? Absolutely not. But when you have, basically all these powers showing their power, like the Federal Reserve being there.
Yeah.
In the short term, there could be a lot of benefit from that, but there's a time when what we're doing now has to, the payment has to come due.
Someone has to pay for that stimulus.
The payment has to come due, right? So, I mean, there's all theories out there, right? From an economic standpoint, we can continue to print more debt to pay off old debt, right? That's what we could do until, again, the bubble bursts, which could be hundreds of years theoretically, right?
Yep.
Or, we raise taxes to help pay for that debt. I mean, there's going to be an effect down the road. If I knew that answer, I would not be sitting here right now. I'd be sitting on my beach with a nice little Corona in my hand. But it is our job to kind of weigh what the impact's going to have. You can't be 100% accurate what's going to come 30, 40 years from now. You don't really truly know that, right?
Right.
But you can put, your odds on what's going to come from this. And do I think higher taxes are going to come? Absolutely. We're at the lowest tax rate environment in history. I think lower taxes are going to have to rise, at least over the next decade.
I mean, look what just happened in Nashville with the property taxes.
Yeah.
They skyrocketed. So, something's got to give. We have this stimulus package, huge stimulus package.
Now they're talking about a second one maybe, right? I mean, but nobody's felt – I hate saying nobody's felt the pain. I understand there's a couple people that felt the pain, but really nobody's felt the pain. The people who are unemployed. Financially.
Yeah.
Financially.
When it comes to health, things like that, but financially.
People who are unemployed are making more – a lot of them are making more money than they were. People who are still employed are making the same. Like, you know what I mean? They're still happy and healthy, and then you have
a lot of these businesses. I mean, they're trying to get our business back. I've seen a lot of great deals, ton of great deals.
Yeah,
I mean, this was
interest rates are low too, so money's cheap.
Yep.
We can just print more money and go and borrow more money for the cost of basically nothing.
Right.
And that's what's keeping the economy afloat, but it's not healthy for the long term.
Yeah. So bringing this back, I mean, it comes down to not letting your emotions run you. We've all had those times where, maybe we lost or something, and you get this kind of fire inside you. One more. We got to play one more, and now you're not playing.
It's called revenge trading. Is when you talk about in the stock market terms. Since you had a bad trade, you want to make revenge on that bad trade, so you try to overtrade yourself when you actually lose more.
But taking that in a normal situation, you're playing a game, you're playing a video game, whatever, you lost. Now you're playing kind of erratically, and you're not playing to the best of your ability, so you really need to put that into your trading. So if you can try to keep your emotions out of it, come up with your buy strategy, figure out what price you are willing to buy it at, figure out a sell strategy. I think that is the most left out thing ever in trading. You really got to come up with that sell strategy, and you're just going to put yourself in a better situation. And if you do all these different things, these different tips, these different ideas that we are giving you throughout these videos, you're going to put yourself in a better spot.
Yep. In trading terms, let your winners run and cut your losers quick. That's all you have to do. If you do that in trading, you will make a lot of money. But the discipline that comes with that
Is really
takes a lot of time and it takes a lot of learning to do. And it might take you a while, right?
Yep.
But again, investing and trading are two separate things. Investing, your long-term portfolios, position those correctly in regards to your age and risk tolerance. In the short term, you can mess with some trading, do maybe some, it's not gambling, but maybe do taking some higher risk trades. By doing that, you're going to learn a lot. And by learning, you're going to actually increase your productivity and your potential over time.
Yep. So, if you have questions about maybe some of those mathematical equations we brought up or any of these topics, just reach out to us. But another huge thing you guys could do for us is give us other topics to talk about and things that may interest you. We understand that finance can be a little dry. So, if we can make this a little more fun and put money in your pockets, by giving you this knowledge, that is what we're looking for. So feel free to comment below. Luke and I truly appreciate everybody who watches these videos, and we can't thank you enough. And hope you're having a good weekend. And next week we'll be getting into 4th of July.
Yeah, good old 4th of July. Happy 4th of July in America.
America.